All right, let's just dive right into this. Imagine a scenario where an economy is completely flatlining. The usual economic medicines have all been administered and nothing. The patient just isn't responding. So I've got to ask you, what happens when lowering interest rates completely fails to save the economy? Well, it's a genuinely terrifying prospect for central banks, but it's exactly the scenario that forces them to break the glass and reach for a highly controversial, extraordinary tool.
Welcome to the Day's Explainer, where we are going to look under the hood of the mechanics of quantitative easing. We're taking a deep dive into this massive economic intervention and will be totally guided by the fantastic insights of author and economic policy expert Oluyomi Ola-David. She lays out exactly what this policy is, how the gears actually turn, and the very real side effects it can have on everyday businesses. She provides incredible clarity on a topic that, honestly, usually feels clouded in dense financial jargon, and we are going to break down her findings step by step.
So here is our roadmap for this explainer. Think of this as tracing the arc of a massive medical intervention for a sick economy. First, we'll look at the interest rate dilemma. Second, what is quantitative easing? Third, how the engine works. Fourth, risks and side effects, before finally looking at unanswered economic questions.
Part 1. The interest rate dilemma. When standard monetary policy stops working.
Oluyomi Ola-David establishes a really clear baseline for us here, contrasting normal times with crisis times. Under normal monetary policy, if a central bank wants to encourage you to spend and businesses to invest, what do? They lower interest rates. The cost of borrowing drops and boom, people spend. Conversely, if spending is out of control, they raise rates to check inflation. But here is the dilemma. She notes that sometimes, particularly during or just after a nasty recession, this standard medicine just completely fails. Even when rates are slashed to near zero, it doesn't rouse aggregate demand. The economy simply refuses to wake up.
And she brilliantly illustrates that this dilemma isn't just some theoretical whiteboard exercise. It happens. Ola-David provides this timeline showing when major central banks woke up and realized their standard tools were useless. Look at this progression. Early 2000s, the Bank of Japan had to use an extraordinary approach to stimulate their economy after their lost decade. Then, following the massive 2007 and 8 crisis, the U.S. Federal Reserve, the Bank of England, and eventually the European Central Bank all had to resort to emergency interventions. The standard rate cuts just weren't cutting it. They needed something much, much bigger.
Which brings us to Part 2. What is quantitative easing? The extraordinary intervention.
So the crucial point is understanding what these central banks actually do when interest rates yield absolutely no desirable results. Based on Ola-David's framing, here's the definition. Quantitative easing, or QE, is an extraordinary monetary policy where a central bank decides to pump money directly into the financial system, and pump is exactly the word she uses. Instead of just tweaking the cost of borrowing, they are literally injecting fresh, newly created funds right into the veins of the financial system to force economic growth.
In fact, I want to reinforce this with a direct quote from our expert. She writes, "Quantitative easing, QE, is a monetary policy means to an end, stimulating growth in the economy." I really love how she frames this. It's a means to an end. It's not a normal everyday policy. It is a highly specific, aggressive tool deployed with a singular target in mind when literally nothing else is working.
Let's move to Part 3. How the engine works. Tracing the flow of new money.
Ola-David breaks down the complex mechanics of QE into a brilliant, easy-to-understand 4-step sequence. Step 1, the central bank electronically creates or prints brand new money right out of thin air. Step 2, they don't just hand this cash to people on the street. They use this new money to buy assets, usually government bonds, directly from banks and financial institutions. Step 3, because these banks just sold their bonds, they are now sitting on a massive pile of new cash. Their capacity to lend increases significantly. This influx of funds tends to lower interest rates across the entire economy. And as the government buys up bonds, bond prices rise, which reduces the rate of return for investors loaning to the government. Finally, step 4, because credit is suddenly everywhere and interest rates are pushed down, businesses are empowered to invest and consumers are encouraged to spend more. That knock-on boost is how the newly created money supposedly heals the sick economy. And according to her analysis, when this engine works, it really works. She outlines several distinct benefits of this emergency intervention. She notes it's obviously the best, and sometimes the only bet, for an economy practicing fiscal consolidation. It powerfully boosts liquidity exactly when there's a severe shortage. This influx tends to increase investor confidence and raises the potential for household consumption to go up. And get this,
It's an incredibly fascinating point she makes. During a round of QE, these massive funds are made available at absolutely no cost to the government or its taxpayers. It sounds almost like magic, right? Well, hold that thought, because every potent medicine has side effects.
Part 4. Risks and Side Effects. The Complications of Emergency Policy.
Ola David offers a stark and completely impartial warning here regarding who actually wins during QE. Large corporates, mostly because they already have easier access to borrow from bond markets, tend to be the greater beneficiaries in the whole QE process. The new money flows easily right to them. But MSMEs, micro, small, and medium enterprises, they face a totally different reality. She warns there are very real fears these smaller businesses might be financially excluded. They might not directly benefit at all. And the reason this matters so much is that she identifies these MSMEs as the true engines of inclusive growth for both developing and developed countries. If the money doesn't trickle down to them, well, the economic recovery becomes fundamentally lopsided.
And that leads right into another severe side effect she critiques, the liquidity trap. A liquidity trap happens when all that new money the central bank pumped into the banks just sits there. Or honestly worse, it goes elsewhere. Instead of making credit available in the domestic economy to help local businesses, banks might just hold off. They might decide to use those funds to speculate on cross-border transactions, hoping for higher and quicker returns internationally. So the medicine meant to heal the domestic economy literally leaks right out of the system.
So how do we fix this? Ola David doesn't just point out the problems, she proposes tangible solutions. She suggests that to spread the effects of QE, central banks can actually advise financial institutions to fix a specific portion of credit to be available strictly for those smaller enterprises. But her ultimate safeguard is fiscal policy. In cases where QE simply hasn't boosted investor confidence and consumption, she states that fiscal policy might just need to step in to serve and bridge the gap that QE fails to fill. Monetary policy simply can't always do it alone.
Finally, Part 5. Unanswered Economic Questions. Looking back to look forward.
As we wrap up this explainer, Ola David points out that there are still several huge questions about the effectiveness of past QEs that demand rigorous, retrospective empirical investigation. We really need to look at the shock effects on aggregate demand. But I want to leave you with her own final provocative question. What factors contribute to the inclusiveness of growth stimulated by a QE episode? It's a brilliant question to ponder. Think about it. When central banks print trillions to save the system, who is really getting saved? Are we building inclusive growth or just rescuing the top? It's something absolutely every focused learner should be asking the next time central banks reach for that emergency glass. Thank you so much for joining me on this explainer. Keep asking those big questions, and I'll catch you on the next one.